Thank you, Professor, for the lift.
You're welcome.
Today you have first class with us.
Yes, and it's going to be very interesting, hopefully.
Today in this video, we are going to be discuss evaluating a firm's financial performance. This is very important topic for analyzing any financial situation. Here we will discuss about the financial performance through the ratio analysis. We will go with the ratio analysis and we will evaluate the financial performance. This is a good thing. In this video, I brought a very important understanding after completing the ratios. So you will get a new dimension after completing this video. Topics what we are going to be covered under this chapter or this video are introduction, steps to developing an effective analysis of financial statement. We'll discuss here financial ratios. We'll develop here a case study and we will evaluate the case study. This is a technology based case study and we evaluate the financial performance of that case study. And in the evaluation, we'll go for the liquidity of ratios. We'll discuss about the operating efficiency ratios. We'll discuss solvency and leverage ratios. At the end of the chapter, we'll discuss about the DuPont analysis. In DuPont analysis, we'll calculate how to calculate return on equity, means return on shareholders' investment. DuPont analysis in this video. Let's start with the introduction. Financial analysis can be defined as a process of assessing the financial condition of the firm. The principal analytical tool of the financial analysis is financial ratios. In this video, we will discuss a set of financial ratios and a discussion of this effective use. Before starting the evaluation, let's take a look on some before questions for understanding in a better way how we are going for analysis of performance. This is a very practical chapter to understand the analysis performance. And once you will analyze wherever you are working, you can analyze the performance of your company. This is my challenge. Please carry on with my video. How do you evaluate a firm's financial performance? In answer, we can say we'll start with the balance sheet and income statement. Before starting this, I will give just more hint. In a second chapter, we discuss about the understanding of financial statement. Financial statement will discuss about the income statement, balance sheet and cash flow statement. But here we are going to be discuss more focus on balance sheet and income statement in a different way. Here we will touch for the comparative mode. So let's come with me. You will get a lot. Carry on. Current assets and liabilities will discuss over there. The current ratios, non-current assets and liabilities will discuss also in this video. We'll discuss about the financial position, means book value, market value, liquid value and intrinsic value, etc. So let's start with the question again. A step to develop an effective analysis of financial statement. Let's go for the steps. There are generally 6 steps what we are going to be follow to analyze the financial statement performance. Number 1, identify the industry economic characteristics. This is very important to go because if you are going to analyze the real estate, there is a different characteristics. If you are going for retail store, you have a different characteristics. If you are going to technology based company, you are having different characteristics. So you must be keep in your mind when you are performing any company's analysis, you must be keep in your mind that what type of economic characteristics is available. We'll work on it. It will be very helpful. Suppose in this video, I brought a technology based company. So when I will explain you in a better way how to solve it. To identify the company's strategies. Assess the quality of firm's financial statement. Analyze the current profitability and risk. Prepare a forecasted financial statement and value the firm. It means at the last we have to be understand the value of the firm. So these are the basic steps if you are going to be analyze any financial statement. So let us go for the another question. How do financial statement help in the evaluation of performance of company? So a company's financial statement provide financial information that investors, creditors, analytics use to evaluate a company's financial performance. Company's financial statement are important tool for a senior manager to communicate past success as well as future expectation. So we are analyzing the financial performance. The reasons are here. Let's go for the financial ratio analysis. Are our decisions maximizing shareholders' wealth? This is a big question, that if we are going to be analyze the performance, what would be after that? It is going to be give any benefit to our shareholders? Let's carry on. We want to answer the questions about the firms. We want to know about the liquidity of the firms. We want to know the efficient use of the assets, and leverage means financing condition of the firms as well. Profitability is very important because all organizations are working to know their profitability position in the firm. So these are the basic analysis we are going to be analyzed when we are going to be observe any. What are the financial ratios we are going to be discuss here? Also important note, financial ratios are the tool that help to determine the financial health of the company. The second thing is there we can compare a company's financial ratio with its ratio in the previous years. This is known as trend analysis. What had before, so what is happening now, and what would be in future. We can determine everything on this way. We can compare a company's financial ratio with those of its. Now, evaluating a firm's financial performance, we'll go with a case study, and this case study I brought related to technology-based company. So here we are going for the next slides. I brought the company's balance sheet, income statement, and other information or financial information related to this company. Then after I will explain to you that how we are going to be analyze the performance or financial performance of this company in a systematic way. evaluation. Let's start. As we said that we will go for the liquidity ratio. We'll solve through the liquidity ratio first. Liquidity ratio are the important ratio to determine the debtor's ability or receivables ability to pay off current debt obligations without raising external capital. It means we don't want to raise the capital. It means we don't want more ownership. Just we want to know how we can increase the money in the business. This is a liquidity base. Find the answer with the following questions to understand. So here we will solve different type of ratios, like what is current ratio, what is liquid ratio. Liquid ratio is also known as quick ratio or acid test ratio. Different authors are explaining in a different way. Some is telling that acid test ratio directly without liquid ratio, but commonly all three ratios are regularly using by different authors in different books, or maybe in different videos you will get a different name, but carry on because I explain you all three. Also, we have to determine the firm's average collection period. It means how quickly firms is collecting their credit sale. As you remember that when we explained that balance sheet income statement, we said that sale all is credit. Keep in your mind. So let's start to learn with me. What is current ratio? We'll go for the formula. Current ratio is equal to current assets upon current liabilities, and go for the balance sheet. Both terms you will get there. What is current assets? It is 50,190 and current liabilities are mentioned 25,523. You will get the answer 1.97. But what the meaning of 1.97 here? Let us go. I will explain to you. Don't worry. A good current ratio is between 1.2 to 2, which means that the business has 2 times more current assets than current liabilities to cover its debts. So it means now you understand that what is the good one. It means your company position is very good now here as a liquidity first position. So if current ratio less than 1 means companies does not have enough liquid assets to cover its short-term liabilities, means company is a risky company, hesitate to invest in that company, and don't involve in any place on that type of company. My suggestions. Second, we will go what is the liquid ratio. Liquid ratio is equal to current assets minus inventories. Even though prepaid expenses, if available in the balance sheet, it is not, then we remove current liabilities divided. Same formula as current assets and current liabilities, just only from the current assets we removed inventories. So let us put the value. We have current assets, inventories value is given over there. We subtracted and then answer we got 0.89. Again, what the meaning of 89? So our good liquid ratio is greater than 1. So liquidity here is challenge. It indicates that the company is in good financial health, and if it's less than 1 means likely to face financial hardship. It means this company is facing financial hardship because it is less than 1. What is the firm's average collection period? It means how quickly firms is collecting his money. The simple formula is there. Account receivables divided by daily credit sale. It means credit sale is divided by 365 days. You will get to know that. Keep in your mind some examples. They are mentioning sale is 360 days. So once they are mentioning 360 days, you can use at 1 year is equal to 360 days. Hope you understand. Let's apply here. Account receivable is mentioned in balance sheet, and credit sale is mentioned in the income statement divided by 365 days. You will get your answer 59.3, because 0.3 we cannot be reflect in a days. So we can say 59 days. So 59 days is our collection period. This company's collection period. The average collection period considered by most of the companies is within 30 days. Collecting its receivables in a relatively shorter and reasonable period gives the companies time to pay its obligation. Means as early as possible you will collect, you can pay your liabilities also. If you are collecting delay, it means you are not going to pay liability as per the delaying payment. Having a higher average collection period is an indicator of few possible problems for your company. It means this company is having some problem, like what? For a logistic standpoints. It means they cannot be keep long-term stock, because they have to be purchased again and again. So they need to manage it. It may be mean that your business need better communication with the customers regarding their debts and your expectation of payments. More strict bills collections steps may be need to be taken. So here the person who is involved in selling the product, he has to be communicate to customers to collect the money as early as possible, then manage the firm in a better way. Now we'll go for the second step, operating efficiencies ratio. So here we are talking about the liquidity. Now we are going for operating efficiency. We'll go with the following questions to understand the operating efficiencies. Number one, what is firm's operating income return on investment? It means whatever money investors are investing, what they are getting back from that. The second, we'll discuss what is their operating profit margin, means profit ratio. What is their total assets turnover? What is firm's account receivable turnover? What is the firm's inventory turnover? What is the firm's fixed assets turnover? And let's come with me to solve these equations, because many things are operating part. Even though you can go for the current assets turnover, you will go for the other further many involvement, whatever you are having, it is related to operating, like gross profit ratio, operating profit ratio, net income ratio. You can calculate in this operating efficiency ratio. Go for the one by one. What is operating income return on investment? Means OI ROI is equal to operating income divided by total assets. Just operating income you will get in your income statement, and total assets you will get in your balance sheet. Put the value, you will get your answer. Again, we'll go to get to know that what's the value here in this form. A good return on investment is depend on the return on organization, risk and return theory. It means whatever risky form is there, they are giving high return. If less risky form is there, they are giving less return. So it means return condition is also showing the riskiness of the organization. As the above case studies technology-based company, even the return is slightly below the industry average. It means we need around 60% return, 16% return on their investment. What is our operating profit margin? Operating profit margin is equal to operating income divided by sale. Here we'll pay value of operating income divided by sale value. Both are giving in income statement. Just go, you will get your values, and the percentage is 10.22%. Operating profit margin is excess between 10 to 12% is considered to be a good. Higher than operating profit margin is better. If you have more, it is more good, but minimum 10 to 12% is acceptable. It is, we can say that in good condition. In business environment, lot of the factors keep on changing the real time, which affect the margin of business. So many events, profit cannot be fixed because of time, because of risk. So you cannot be say that this year 10%, next year again 10%. No, it may change about the situation, about the other many reasons would be there. Total assets turnover. Total assets turnover is equal to sale divided by total assets. Sale you will get in your income statement, and total assets you will get in balance sheet. Put the value, you will get your answer. It is 1.3 times, 38 times. What's the meaning of 1.38 times again? As per the all analyst, means financial analyst view, for the assets turnover ratio, the higher is better. Whatever maximum you are having, it is good for you. The above results indicate that you are using your asset efficiently. For instance, an assets turnover ratio 1.38 means you are generating 1.38 times of sale over every dollar of assets in your business. What is account receivable turnover? Account receivable turnover is equal to credit sale account divided by account receivable. It is also known as debtors receivables. Some organizations, especially UK-based organization, is still using the debtors word instead of receivables. So they can use the sale, credit sale divided by average debtors. Same. So we will use the credit sale value divided by account receivable. And the answer is 6.16 times. What the meaning? The industry average is 8.2 times. It means we have little bit less. So a high receivables turnover ratio can indicate that the company's collection of account receivable is efficient, and the company has a high proportion of quality customers that pay their debts quickly. It means if you are having less, it means your customers are not repaying, and it is reflecting in liquidity ratio. If you will go back, you will get the same result over there. We'll go for the inventory turnover. Inventory turnover is equal to cost of goods sold, again divided by inventory. Cost of goods sold you will get directly in income statement, and inventories you will get in balance sheet. Here normally we are using closing inventory. If we are having opening and closing both, we have to be get the average inventory, means opening plus closing divided by 2. But if you are having only closing, it means only available in balance sheet, we can use that inventory here in the formula. So let's put the value what is available in the balance sheet and income statement. The result here is 3.10 time. Of course, all business are different, but in general, the ideal inventory turnover ratio is between 4 to 6 for the many industries. I'm not talking about specifically about the technology industry. Mostly industries are keeping here. Usually industry means inventory turnover means that the rate at which your restock items will balanced with your sale. So it means against you will find here the slight less, not according to the analyst views. We'll go for the fixed assets turnover. Fixed assets turnover is equal to sale divided by fixed assets. We'll go for sale, and fixed assets amount is also given in balance sheet. You will get the answer 3.56 time. What does the mean? A high fixed assets turnover ratio indicate that the firm effectively and efficiently use its assets to generate revenue. A low fixed assets turnover ratio generally indicate the opposite, means companies does not use its assets effectively to generate revenues. So here we cannot be say that it's a very good ratio because not in high level, but at least in a better position. Now we'll go for the third value of ratios, that is a solvency, or we can say leverage ratio. It is a financial decision of all organization. Here we have some questions to answer. The solvency ratio. How does leverage work? The second thing is what is debt ratio? Means debt, you are very much aware, means whatever money you received against the loan or against some securities. What is the firm's time interest earned ratio? It means firms is investing somewhere when they are getting back their interest. Let's go for first how to does leverage work. Now I will explain the leverage with two situations. Situation one, suppose we have an all equity finance firm. This is other than the case. 100,000, its earning is suppose total 15,000. Assume no taxes for this example, because in second chapter we understand about the income statement, we use taxes. Here we will not means go for the taxes to understand in a better way. ROE, return on equity, will apply. It means owners are getting 15,000 out of their investment 100,000. It means their return is 15%. Let us go for the situations 2. Suppose the same 100,000 firms is financed with half of debt, means 8% bonds are there. It means this company is not all equity firms. Equity firm is whatever you are getting, this is your ownership money. If debtors are there, it means bonds are there, it means you are not getting all return with you. You have to be pay 8% interest to them. Let us see the situation here. RO is equal to how much is there? 15,000 minus 4,000 divided by 8,000. From where you got 4,000? 4,000 means 50,000 amount you receive from the bondholders at 8% interest rate. So 50,000 multiplied by 0.08, you will get 4,000. 4,000 the interest amount what you are paying to your debt holders. Okay, so this 4,000 is going to be reduced from the owner's money. So now owner's money is 15,000 minus 4,000 divided by owner invested only 50,000. So now this time we are dividing with 50,000. So now their percentage increase. This is a leverage. This is a gain by the owner. So if owner pay 50%, means 50,000 instead of 100,000, they are in a better position. Their return is better than the return when they are investing whole. So sometime investors are telling that Maybe debts are the cheap source of financing. That's why in all structures you will find the people are getting for loan. They are investing money through their bonds. So this is the only reason. I hope so now you understand about the leverage. We'll come back again our case study. So let's continue with the above case study. We'll go for what is debt ratio. Debt ratio is equal to total debt divided by total assets. So here we'll put the debt value is given in your balance sheet and assets value is also in balance sheet. The percentage is 58. Generally a ratio of 40% or lower is considered good for the debt ratio. It means here you are having high side debt ratio. A lower debt to assets ratio suggests to a stronger financial structure. It means you cannot be give the more ownership to the debt holders. It means here it is showing that 58% outsiders in money is in your business. So this is again showing the riskiness, as before 2 times we saw the riskiness of the organization. Just a high debt ratio suggests high risk. So here we can say that this company is in risk. This is 3rd time we are telling this. What is the firm's time interest ratio? So time interest ratio is equal to operating income divided by interest expenses. Again, operating income you will get in income statement, interest expenses again it is given in balance sheet. You will get the percentage, this is 3.6 times. So it means the industry average is 3.65 times. This is a future evidence that the firms uses more debts financing than average. So it means it is a risky firm. Ratio on return on equity. We already get the average. Now we'll go for understand about the equity ratio. Return on equity is the measures of financial performance calculated by dividing the net income by the shareholder on equity. Because shareholders' equity is equal to the company's assets minus debt. ROE means return on equity is considered the return on net assets. When I saw the leverage, I show already this example or this type of formula. But here again, we'll repeat with this question. Net income divided by common equity means shareholders investment. So our investments money. So here we have net income 5016 divided by 34,367. So 14.6% is return. So ROE is 15 to 20% are generally considered as a good ROE. We can say here somehow near about. Now, conclusion of the case study. So we solved liquidity issue of means efficiency issue, solvency issue, and also return on equity means shareholders investment. What we get to know that even though the above case study has high leverage than the industry average, they are much less efficient and therefore less profitable. So due to the riskiness, companies getting less profitable company and investors may be hesitate to invest. This is a conclusion of analyzing efficiency of this company, this case study. My suggestion, please go for some companies, collect their balance sheet, income statements and try to solve in this way. So you will be perfect financial manager to understand about the corporate finance. Please carry on and give your comments to me in your comment box that you are liking or understanding this in a proper way. Let's continue this ROE because all investors, all shareholders are looking for their investment. So we have another approach to calculate return on equity that is known as DuPont analysis. The DuPont analysis is also called a DuPont model. This is a financial ratio based on the return on equity ratio that is used to analyze company's ability to increase its return on equity. The reason, number one, a DuPont analysis is another approach to evaluate a firm profitability and return on equity. Because in equity, we cannot be understand that what the reason why equity is that much. So that's why we have to be know to go for a DuPont analysis. The second thing is it is a graphic technique may be helpful in seeing how ratios related to one another and the account balance. Return on equity is function of a firm's net profit margin, total assets turnover and debt ratio. So here 3 ratios are involved to analyze the DuPont analysis, not only one. So equity is based upon three particular ratios. Let's go again. Satisfactory return on equity on the derived through higher return on assets, significant utilization of debt, combination of both. What is the both? Return on equity means return on assets investment divided by 1 minus debt ratio. So here we have debt divided by assets. Return on assets is also, as you know, that it is a profit margin multiplied by assets turnover. So we have a profit margin ratio and assets turnover ratio. We can imply both, then we will get to know that. DuPont analysis in a graphic way, you can say that net income divided by sale, you will get profit margin. This is a formula for calculating profit margin. Our sale divided by total assets is equal to assets turnover. I already showed you this formula when we solved the above case. Profit margin divided by total assets is reflecting return on assets. Same, if you come down, total debt divided by total assets is showing financial or financing plan. So return on assets divided by 1 minus debt assets or financing plan, you will get a return on equity. I hope through the graphic also you understand that how we are calculating return on equity. You can use this formula in the above case, you will get the same return on equity. This is a assignment for you. Please submit to me on my Moodle page. There is no marks for this. This is just for only understanding. If you understand, please, I want to know that whether you are watching my video in a proper way, understanding in a proper way or not. All students, those are watching my video, please solve this and give the comments on my YouTube channel or under the video in comment box. If you have any problem, please don't hesitate to ask me any question on it. Let's solve this problem for you. For your more understanding, example for the DuPont, ROE will put the value net profit margin as I give the formula multiplied by total assets turnover whole divided by 1 minus debt ratio. Just put the values in the formula. As you know that net profit margin is net income divided by sale and total assets turnover is equal to sale divided by total assets, and 1 minus debt ratio is equal to total debt divided by total assets. So here we will put the value. All values are given in the same, as I told you, that same case. So ROE is equal to net income, we will given there, divided by sale divided by total assets, 1 minus total debt divided by total assets. You will get the same answer, 14.6%. So it means either you are using DuPont or you are using total return on equity formula directly. There is no change. But this formula will give us the understanding why 14.6% came. Means what is our percentage of profit, what is our total assets turnover, what is our debt equity ratio. This is the mix of three formula in a better way, better evaluation. I hope you understand. There is no need to solve now. You get to know this in a proper way. But again, take some examples, solve it, and give me back your comments, your things that what you understand after completing this video. I hope so you enjoyed this video. Now this is a time to close the chapter. Thank you very much to be with me, and always be with me with my new videos. I will try to help you, but don't forget to like and subscribe my channel, my videos, and I'm waiting for your comments, your likes. Goodbye.